has taken a view that if you lease it 100%, it is a real estate business. And therefore, several developers out of abundant caution go to FIPB for approval, which has always taken a view that this is not real estate business. And this we have experienced, we have written to RBI and received a negative clarification that this is real estate leasing business, which is absolutely wrong. As a developer, if I'm an IT park developer, I never sell it. I always lease it out. If I'm a commercial project, I never sell it. So, in such a case, RBI, certain managers have been known to take a negative view, and therefore, what people generally prefer, and this I have heard from several large guys, go to FIPB, you always get a positive view, and then RBI cannot do anything else. So that's a practical point. If you want to play safe, go to FIPB, although I don't think it's required.
Sir, in addition to this also, when you submit the FCGPR, the Reserve Bank always asks to delete the lease clause from the main object.
Correct.
They force the people.
Right, that's what, because RBI feels if you lease it, it's real estate business, which is absolutely wrong.
So, Anup, I just want to add, if I remember correctly, unfortunately I didn't have enough time to rush through some of these. There is an example in one of the FIPB reviews, I think whether it is 2009, and it is vis-a-vis certain other schemes, like an IT park scheme, and they specifically clarified about the leasing being permitted.
Correct.
So there's a specific
FIPB always makes it very clear.
So I don't think that's an issue. I mean, if anybody has a concern, I mean, perhaps what Anup is saying is maybe right, but I don't think the legal part prohibits leasing.
Right.
Yeah.
I have a variant to your question, the earlier question. Say,
Can you take it to the variants?
just a variant.
Just a variant.
They test it for the variance.
Yeah. Okay, so say there is an Indian company with 49% FDI.
Yes.
Now, technically that company is India controlled company because the 51% shareholders are all effectively residents of India. Now that company, can I say it is an India controlled company? There is no, it's not a foreign
There is a
controlled
question on
company.
the same subject, so if you don't mind.
Okay, no problem. So
We have
my
an
simple
answer
question is, can they do real estate blanket
That
without any
that
restrictions?
question is covered.
Okay.
So I think we also discussed this yesterday in the presentation. That depends on how conservative or aggressive you want to be, because then you can do anything below.
Yeah.
Anyway, we'll pick that up in the question.
Question 4.5. So the answer is yes, an industrial park must only meet the conditions specified in 6.2.12 of the consolidated FDI policy and the relevant paragraph under the FEMA notification 20. There is no condition that it must be notified by any authority as an IT park. That is under section 80IA 3.4 of the Income Tax Act. If you want to claim deduction under section 80IA, you need to follow the industrial park scheme of 2008, which is laid down by CBDT and central government. There the conditions are much more onerous as compared to under the FDI policy. So what may be an industrial park for FDI need not be for industrial park scheme, and vice versa it is always so, because if you are covered there in the larger clause, you will always be covered in the smaller clause. So answer to this query is yes, you can develop an industrial park even with smaller, as long as you meet the conditions laid down under the FDI policy.
Yeah, 4.6 is FDI in pharma sector. Actually, this one seems to be now fairly simple because the latest consolidated policy has removed that word, existing in an Indian company. So now it purely needs greenfield and brownfield. So I don't think this controversy now survives. The latest policy, friends, if you see, the categorization is purely clear: greenfield 100% auto route, brownfield 100% government route. So this controversy which was there, FDI in an existing company, whether it requires FIPB approval, hopefully now stands done away with.
4.7, again pharma sector. Here we are looking at a transfer from a non-resident to a non-resident. Now this is an interesting scenario. There is no express clarity. Under FEMA regulations, transfer of shares from a non-resident, not being an NRI, to any non-resident, even including an NRI, is on an automatic route. There is no pricing, no reporting, no documentation norm specified. Hence, it stands to reason that no permission is required. Even if you look at para 3.6.2 of the FDI policy, you need FIPP permission for resident to non-resident transfer if it's not on a 100% automatic route under the FDI route. Now, this is non-resident to non-resident transfer, therefore, can take a stand that it is on the automatic route. But having said that, because it is in the pharma sector, which is a sensitive sector, and there is no express clarity, experience has shown that more and more people are going to FIPP even for NR to NR transfers. One of the most popular cases is Castleton, which we have under the income tax AAR ruling. Castleton, Mauritius wanted to transfer shares of Glaxo India to GlaxoSmithKline Singapore. They went to FIBB. FIBB kept deferring the proposal for about 5 meetings. Ultimately, they approved it. Other examples are Fenwell India and Cordlife Life Sciences. Both of them are NR to NR restructuring where FIBB has given permission. So whether it is out of abandoned caution or it is out of ignorance, people are going to FIBB, and I think it's a better course because of the pharma sector ambiguity that whether this brownfield, greenfield distinction only applies to when a non-resident is acquiring from a resident. There's nothing saying so. It just is in favor of a non-resident. So better course, in my view, also would be to go to FIBB for permission.
Yeah, also, just I would like to supplement here. I think the view is in an NR to NR transfer, I think that's what this case is. There is no funds which would come to India in that classic sense. So there is also a view that if there is no inward leg involved in a transaction, then FIBB approval is not required. I think that's the ground on which people would take a clarification from FIBB, because really there is no FDI which is happening in that tax stage. Okay, I'll go to question 4.8, which is deferment of, transfer of shares on deferment. Now, I think here it seems there is a deferment of only 20 days. Okay, and I think what we really need to understand is that perhaps these 20 days is not deferment. It's not a deferred payment consideration or a deferred consideration. It's a milestone. When you have obviously in any sale transaction, you will have closing condition precedence of in terms of how the deal will happen, that the XYZ will do few things, the buyer will do few things, the seller will do a few things, and then the money will be paid. So I would not treat this 20 days as a deferment. It's actually a milestone, the way I look at it, and it's a normal deal. In typical any normal deal, you will never have the shares and the money exchange on the same day. There would be some normal milestone, and so long as it is like 10 days, 15 days, I don't think one would look at any such case as a deferment case. So I don't think this is a case of a deferred payment of any consideration. Yes, typically if you have an underlying credit given, after you transfer the shares, and if there is a long period for payment of that money, those would be a deferred payment, but not typically if you word it properly and say that basically it's a condition precedence that okay, this will happen, that will happen, couple of checks will happen, and then the money would be paid. So I think if this facts relate to those type of cases, I wouldn't see a deferment over here for 20 days.
Correct. Just bear in mind, even the Securities Contract Regulation Act, Section 2 requires a spot delivery contract to be settled, delivery and payment on the same day as the contract or the next day. So within 48 hours you need to settle delivery and payment. And a couple of years ago, till then we always presumed this applies only to listed companies. Supreme Court in Naresh Agarwala has taken a view there is nothing in SCRA which applies only to listed companies. It would even apply to unlisted companies. So now the general view is even unlisted public companies and even private limited companies would be covered by SCRA. So unless you can weave in that also, you may be compliant with SEMA, but you may be violating SCRA. So bear that in mind also.
So this is from the perspective that even a partly paid shares to non-resident Indian is not allowed to issue, or a non-resident for that reason. So how can a share be transferred without receipt of the money? That is the real question.
So then that's deferment.
No, I'll tell you. So Paresh, let me answer that. So maybe I'll just step back a bit. See what happens when there is a transfer of shares. There is an FCTRS procedure and everything that has to be complex. So technically what he would have got, he would have not got the transfer in his name. The transfer in his name, either through a physical transfer or from a demat account, can happen only after the ED bank has approved the process. And therefore, this payment will happen, and then within 60 days, whatever you will have to do the FCTRS, and then only the legal transfer will happen. This is only a milestone, and I mean, whomsoever is the advisor here will have to put the proper milestone. So I think the question is worded in a little confused manner, because typically this is not how somebody will do a deal. So if you will have to put on whole milestone, for example, okay, you will put on condition precedence, and there will be 10 condition precedence before legally the shares get transferred in the name of the buyer. So I don't think you will get to a stage where you will transfer unless the money is paid and unless the FCTR has happened. So I don't agree this will be exactly the way it ought to be, stated.
4.9, this is regarding options and derivative trading. Now here, it needs to be borne in mind that if PQR is a stockbroker, and he wants FDI and this he is doing as a broker, then it is a permissible activity. But what this says is he wants to be registered as an AIF category 3. And an AIF presupposes that you are doing it not on your behalf, you are doing it on behalf of your investors. That is the meaning of an AIF. You are pooling funds and you are carrying out an investment on behalf of your investors. Now, AIF category 1 is one of the categories is venture capital fund, which is on an automatic route. But anything else requires FIPP permission because it's not there within the 19 activities. So what this is, category 3 is like a hedge fund or anything which does complex derivative trading activities. All that would require FIPP approval. The second question says, is there a policy rethink? Yes, SEBI had as far back as in August 2013 written to the Finance Ministry and RBI that you need to have a clear-cut policy on FDI and AIFs, otherwise we're going to be strangulated. But there's been no movement on that, so hopefully we have something once elections are over. What are the implications of the recent circular number 112? 112 allows the registered foreign portfolio investor to directly trade in derivatives on his own account. What this is saying is I'm investing in a company and the company is trading on my behalf. So that is an AIF. And an AIF, if you want, then 112 will not come to your rescue. You will have to take FIPP approval. Generally, having said all of this, AIFs are not structured as a company because it is not very efficient and it's normally done via a trust mechanism. And any FDI in a trust always requires FIPP approval. And there are enough instances like India Ocean Fund and other AIFs which have gone to FIPP for permission and received permission. So generally you would see an AIF being structured in a fund as a trust or an LLP, but not as a company. That's the general by and large. But if it is a company, you would need FDI approval also in that.
2.10 valuation of rights issue. Again, this is a very vexed issue. I touched this in my presentation yesterday. So it seems there is an issue. There is a rights issue. There is no requirement for a valuation report subject to the price of the issue for non-resident being same as the price for the issue for resident. See, many banks are insisting on a valuation report. So I am not sure why the bank would insist on a valuation report if you have resident as well as non-resident shareholders and the issue price is same for both of them. That's a very clear provision. Even if they want a valuation report, you can say that this is the process that has been followed. This is how the price has been fixed by the board, and it is same for resident and non-resident in compliance with the FEMA pricing guidelines. There is no need to do a full-blown valuation report. So the valuation of right doesn't mean fair valuation of the equity shares. If that's what they might be just asking for a certificate that the price is same for both the shareholders. So I'm not sure really what the banker is asking. There could be some caution here if there is if the Indian company that is issuing the rights is a wholly owned subsidiary of the foreign parent. In which case, as I said, there has been some case where RBI has raised eyebrow as to how a wholly owned subsidiary can do a rights issue because there are no resident shareholders. Fortunately, I have seen some questions, I have seen some responses. At least I have not come across anything which is significantly adverse, but that's a part which at least I would not recommend to follow. Because if you have a wholly owned subsidiary, you might issue shares at a premium, there's nothing to lose on that. Just do a valuation and do it at a premium. So I really don't understand this question as to why the banker is insisting, but he may be just insisting to see whether the price is properly fixed as per the RBI guidelines. I don't think he's insisting on a DCF valuation over there. If that's the case, all you have to give, just give a plain vanilla certificate that yes, this is a company which has done the rights at so and so price, and the price for the resident and the non-resident shareholder is same, and it is in compliance with the FEMA regulation. I think that kind of a certificate should work for the bank.
4.11, we've already, so Shabir Bhai has answered. The real estate business, leasing, whether it's through a partnership or it's via a company, I think if it is just acquiring immovable property for leasing, that would be real estate business, and even if you do it via a partnership firm, it would, in my view, tantamount to real estate business.
4.12, conversion of FCDs. The company has issued FCDs, form FCGPR has been filed at the time of allotment. What compliance is required at the time of conversion? Do we have to inform RBI again, and at that time the number of shares allotted? Now friends, again, the FEMA 20 is not very clear on this in terms of, I mean not in terms of the reporting. Of course there is no reporting prescribed at the time of conversion. Neither FCGPR, neither plain paper reporting. However, as a measure of good governance, At the time of conversion, you could choose to write one letter to RBI that look, we had issued this so and so, CCDs, and now they stand converted to so and so equity shares. Also, what I understand from a couple of cases that I have seen is that when RBI takes such convertible instrument on record, it also mentions the number of equity shares it will translate to. If your translation is exactly the same, for example, you don't have a formula-based conversion, and you're taking on record of the original issue as well as the converted issue is in line with the RBI letter. Because I've seen a couple of RBI letters where they've said, okay, so and so issues to be converted into so and so, and eventually it will probably translate into so and so number of equity shares. And if your conversion is exactly in line with that letter, perhaps nothing is required. But if you have a formula-based conversion or there is some mismatch in what RBI has taken on record, maybe you will have to clarify that. Okay, I had put in a formula and I'm applying this formula, the conversion has happened, and now instead of so and so equity or whatever, so and so equity has gone to the non-resident, and the revised shareholding in the Indian company stands like that. So I think this will all, so okay, let me just rephrase my answer. There is no need to file an FCGPL to the, at least according to my reading of the law. You could choose to do a plain paper reporting. A plain paper reporting is a must if there is a mismatch between what RBI has taken on record and what's happening in terms of your conversion. Because that's something which will need to be sorted out with the regulator.
4.13, extension or advancement of conversion period of CCDs. Now, the guidelines say it should be converted within a specified time frame. What is specified time frame? Once you specify, can you extend or can you prepone it? I believe it should be possible because even though you were extending or preponing, it is yet within a specified time frame. You are not saying indefinite. So if you say it may be done whenever this milestone is achieved, that would not be correct. But if you say within a time frame, should be possible. In Sampad Vikas, FIPD has taken a view that 8 years time frame for converting CCDs is a reasonable and valid time frame. Having said all of that, out of abundant caution, you have had instances where companies have approached FIPD for extension of conversion. Best example being Walmart. They had 100 million invested in the Bharti Walmart deal, and the conversion period expired on October 13. They have approached FIPB for extension of the time of the CCD conversion, and there's not yet been any finding of FIPB. I think it will be postponed till after elections. So that has been one example which comes to mind of people going to FIPB for extending the CCD conversion period. Although there's nothing anywhere which says, neither in the forms nor in regulations, that you need to apply to FIPB. But as often it may be better rather than taking a call afterwards, because they may take a view that specified means what you specified initially, and now whatever you do is a change, and if there is a change, you need to come to us.
So, Anup, I would just like to supplement here first. In my recent one of the experience, FIPB has redirected such application to the RBI. And at least, my interaction with RBI suggests that they believe that the specified time is the original time and it can't be changed. You can prepone it, but you can't postpone the conversion. So that's the view they have been taking. And therefore, to that extent, this matter becomes a bit more vexed, in terms of what you want to achieve. So there are, apart from Walmart, there are a couple of other FIPB, instances where FIPB has initially approved. I think off late they are not approving. At least I'm talking about a fairly recent case in the last few months. So that audience will want to take note of that. Alright, let me go to the question of forward cover for share application money. Again, a very vexed issue. I'm not going into whether the forward cover was rightly or wrongly taken and who should have taken it, but nevertheless, ultimately, I think what needs to be looked over here and what is not coming in the question is what is mentioned in the FIRC. With the FIRC, I believe will be for 58, which will be the prevailing price, and 2 rupees is a gain which has come to you because of the forward cover. Therefore, technically, according to me, the better approach would be to restrict the allotment for the 58 price. And the 58 price is something which should also get reflected in the FIRC. Because what gain, now if you made a loss, then again that's a different situation. How would you do it? But here it seems, you have booked a cover at 60 and you got a credit at 58. That means the dollar prevalent price is 58 and you sort of paid 2 rupees as a premium or whatever. But you got 2 rupees extra because you booked the forward cover. So to that extent, the inward remittance is supported only by 58 rupees and the 2 rupees is the bank which is giving you extra. Technically, that's not really the money which belongs to the foreign investors. I would typically Perhaps if the FIRC reflects 58, which in my view should be the right case here, then go with the allotment at 58 and not 60 rupees.
Sir, can we take a forward for against such a...
That's why I'm saying I'm not going into that question. That's not what is asked over here. But I'm assuming, yes, there have been many instances where people have taken forward cover, rightly or wrongly. The circular is not that very clear. And this is I've seen few cases on these lines as well. So I wouldn't say it's entirely right or wrong. But
Now 4.15, 1, 2 and 3 all are subsets of the same question, so the answer could be more or less the same. So it's downstream investment of a company owned and controlled by resident Indian citizens. Here there has been a lot of ambiguity on whether you can bypass sectoral caps if the investing company is owned and controlled by Indian citizens. So in our example, the chart here, C Limited, which is an FDI compliant project, owned and controlled by resident Indian citizens, is making an investment in D Limited, which is non-FDI compliant projects. Is that possible? I believe it is possible because C Limited is owned and controlled by resident Indian citizens. That is more than 50% of the capital and the board and majority voting rights, shareholder agreements, everything is in favor of ultimate Indian citizens. Is there any precedent which we could use, which is a reported precedent? And fortunately there is one. If you look at Tata Sky Limited, which is the DTH operator which you have, at that point of time, Tata Sky, the DTH sectoral cap was 20%. So you look at D Limited as Tata Sky Limited. You get C Limited as an investing company floated by Tata Sons, where it had 51%. And you look at a foreigner coming in, that is Star TV, which we all are familiar with, coming in at 49%. Now Star TV had a direct investment in Tata Sky of 20%, which was up to the sectoral cap. By virtue of investing in the SPV floated by Tata Sons, its indirect stake was going to 49%, which was way above the sectoral cap of 20% at that point of time. They approached FIPB for clarification, and FIPB said this is permissible under press note 2, 3 and 4 of 2009. There was the first case which tested FIPB on these press notes, and FIPB has given a green signal. Therefore, in my view, it is possible to go into real estate sectors of less than 50,000 square meters also, provided it's the board composition, the shareholder rights, everything. There should not be any ambiguity. Like now, the control definition has also been extended. It was not just the right to appoint board. You even need to look at management rights, veto rights, all of that. So taking a holistic view, if you can say it is owned, ownership is more or less easy, but if you can say even control is ultimately with Indian citizens, then yes, you can invest in B Limited via this. But I do have my share of detractors and I do know that, but I believe this is possible. Reporting, whether you need to report all downstream investments, because 14E62 is, or only those downstream investments which are owned and controlled by resident, but not controlled by resident Indian citizens. Now here, if you look at the heading of regulation, sub-regulation 6 under 14, it talks of downstream investment by a company which is not owned and controlled by resident Indian citizens. 6.161 again talks of downstream by a company which is not owned and controlled by resident Indian citizens. But when you come to the reporting requirements in the sub-clause 2, it talks of all downstream investment. So does it mean any downstream investment where there is even 1% FDI needs to be reported to FIPB, needs to follow the valuation norms? I don't think so. I think you need to look at it as a holistic view, and you need to look at the overall heading and 6.1. It should only be in reporting in those cases which are owned and controlled by non-residents, and not any and every reporting is to be done to SIA and DIPP. And if you look at some support for that, the recent FAQs which were issued in March by RBI on FDI, question 38, are there any exception on application of downstream investment? So the answer is yes, the downstream rule may not be applied in the following cases where the first level Indian company is owned and controlled by resident Indian citizens. So in such cases, the downstream investment rule per se does not apply. Then where is the question of reporting any such investment to SIA and DIPP? Otherwise, even if you have one share to an NRI, you are going to have to go and report to DIPP, which obviously is not the intention of the law. So it is a case of bad drafting, and the same bad drafting is even found in the consolidated FDI policy. So it's just been carried forward into regulation 14. But I believe you don't have to report such cases to SIA and DIPP. how would valuation be done if company A or B is operating cum holding, and since it is an operating company? So this is asking the question that when the first level company is getting the FDI, you need to issue shares at or above DCF. Now, one of the things which this company is going to do is its own business, because it's an operating company, and come an investment company, so it's going to carry on business. Can you look at a consolidated DCF valuation? I don't think so. But what you can do is you can factor in the dividends which the investee company will declare to you and into the free cash flows, and then carry out the valuation. That should be a better basis of valuing. But this is a hurdle point, that if you have an investment company, then, or if it's a pure investment company, then also what is there in the valuation? Only dividend and interest. Therefore, if you look at the recent monetary policy statement of the RBI Governor Dr. Rajan, on 1st April, he said there is a need for doing away with all valuation on DCF based for FDI issue or transfer, and to go on to mutually acceptable forms of valuation. And that is how valuation should be done. So that's what RBI is going to be doing, but operational guidelines are yet to be notified. So coming forward, I think in the next month or so, what we're going to see is no DCF for FDI, no DCF for transfer, direct at a mutually acceptable, at a valuation methodology which is internationally acceptable. So that's a better course, because when you're doing an NBFC company FDI valuation, I'd like to look at a price to book value method of valuation. I'd like to look at a price to asset multiple. So all that I can do once I'm doing away with the DCF embargo. So that's stated in the monetary policy, so it's only a matter of time before it comes into practice. The rules state that downstream investment pricing has to be done as per RBI rules. Do I need to obtain a certificate? If it's a company owned and controlled by non-residents, then it has to be, valuation has to be as per the RBI norms, which is not lower than DCF. So even if an Indian company, the company which has got FDI, is investing into another Indian company, but the first level company is owned and controlled by NRs, then the investment, the downstream, has to be at higher than DCF. Now, if it's got to be at higher than DCF, how will you come to know unless you get a valuation report? So yes, you do need to obtain a valuation report, although there is no requirement to file it with any authority, like in the case of the first level company, because you're not filing with RBI any FCGPR. You do have to obtain it, and you keep it on your record. If a query arises, you submit it to, because your auditor, that's one other thing, the auditor needs to certify, the auditor of the company getting the FDI has to certify that all compliances under downstream investment have been complied with. Now, one of the compliances you would like to look at is whether the valuation is in accordance with DCF pricing or not. So you would need to obtain a DCF valuation even for the downstream if it's by a company owned and controlled by non-residents, and satisfy it to the auditor and ultimately to RBI if a query arises. Is FCGPR to be filed? No. Even the RBI's FAQs say that for the downstream, please do not file any FCGPR, because this is not a case where you bought FDI. This is a case of company, Indian company investing in another Indian company. Overall, Indian company does not cease to go away. There is no need to submit valuation report with answer. The form is to be obtained for intimation on FIPB's website. But if you go to FIPB's website, there are only application forms. There are no intimation forms. Hence, a plain paper application should be doable. You don't need to have any application form. The last one is an interesting question, that what if a company is 50-50 owned by residents and non-residents, or if it is controlled 50-50? Now, this is a very vexed issue which is arising because of drafting difference between the FEMA regulations and the consolidated FDI policy. If you look at the consolidated FDI policy and press notes 2 to 4 of 2009, what they define is a positive definition of a company owned and controlled by resident Indians, and a negative definition of those owned by non-residents. Any company which is more than 50% owned by Indians is owned and controlled by Indians. Any company which is not owned and controlled by Indians is automatically a company owned and controlled by non-residents. So it becomes very easy that if it is a 50-50 case, it should be treated as a company owned and controlled by non-residents. What the FEMA regulations have done is they say a company which is more than 50% by Indians is owned and controlled by residents, which is more than 50% by non-residents is owned and controlled by non-residents. So what happens in a borderline case where I'm 50-50? I'm neither owned by Indians, I'm neither owned by non-residents. And that is arising because they have given two positive definitions. What you needed to do was, one was positive, other should have been negative. Automatically you could have fallen under here or there. Now, So you have a mismatch between the FEMA regulations and the FDI policy. Which prevails?